What's up everybody, Gen X Dividend Investor here. In this frequently requested video, I update you on where my multi-million-dollar dividend portfolio is today, including showing you a new record I got this week for dividends received in one day. I'll also tell you some interesting tidbits throughout the video, so I strongly encourage you to stay until the end. But before I kick this off, I wanted to give you a heads up that I'll be heading out to vacation in Europe for a couple of weeks shortly after this video airs, though I'll still be chatting with folks in my Dividend Discord, and I'll be sharing some of my travel pics with people that have joined my channel membership, and I plan for my next video to come out on May 25th, shortly after I'm back. Okay, so for any new subscribers who haven't watched my old videos, then my quick background is that I've been investing for over 30 years, and started as a programmer working at a small company, and eventually moved into tech management, leading teams doing info security and programming and project management and stuff like that. I've never worked at any cool places like Google or Amazon or Apple or wherever, and in fact most of the companies I've worked for no longer exist, either from going bankrupt or getting acquired. So either I'm cursed or very lucky, depending on how you look at it. I've been married for over 25 years, and neither me nor my wife were ever given anything other than token stuff throughout our lives, and neither of us have ever won the lottery or inherited anything, and in fact we started at a negative net worth when we got married because she had some credit card debt. I explain that so you understand that my portfolio came from decades of investing, not because I'm a trust fund kid or whatever. Okay, so my dividend portfolio is in Fidelity, and when I took this screenshot on April 30th when the market closed, you can see that in total I have about $2.94 million worth of stocks, and they generate about $126,000 of dividends a year. And before you leave me a comment telling me how I could make more money if I was in higher yield stocks, or that if I just kept all my money in the bank I could get 4 or maybe 5% interest, then instead sit back and reflect on why I don't do that. There's actually lots of reasons, including the fact that tons of my gains have come from stock appreciation and reinvested dividends over the years, and I'm fine with having some market crashes and volatility in the short term, because in the long term I believe that the US market will continue to do just fine, and that my stocks will outperform bank interest on average. Note, I've blacked out some information that I don't want to share, like my account numbers and stuff not tied to my dividend portfolios, and I sometimes record different parts of my videos throughout the week, so sometimes you may see minor differences between screenshots. I have about $1.32 million of dividend stocks in my IRA, which isn't a Roth because Roths didn't exist when I started investing, and I made the mistake of not starting one when I found out about them. I'm currently withdrawing my retirement account dividends early, which means I pay ordinary income taxes plus a 10% penalty on them. I also reinvest some of my IRA dividends for a few of my tickers. I gotta tell you, it's really cool to finally start taking some of my dividend cash out of my retirement accounts after seeing money only go into them for so many decades. My portfolios honestly feel like infinite ATM machines that just keep filling up with cash and that I keep withdrawing out of to pay bills. Of course, dividends aren't free money, since your companies are paying them out, but they do feel that way. After my IRA, I have about $1.44 million of dividend stocks in my taxable account, and I have about $180,000 worth of stocks in a rollover retirement account for my wife that I manage. My wife's hourly jobs over the years often didn't have 401ks, and I made the mistake of not focusing on building her retirement account like I did mine. Someone recently asked me how I can buy and sell in my wife's IRA, even though it's in her name, and what we did was ask Fidelity how I could manage it, and they had me sign some forms in front of a notary, and now I can buy and sell stocks in that account even while I'm logged in mine, which makes it easier for me to manage our finances. I don't think my wife has literally ever logged into her brokerage account, but I have created a document which explains our dividends and all of our finances for her, in case something happens to me. Now the markets closed red when I took this screenshot, which is why each account is down for the day. As your accounts grow, you'll obviously see greater dollar swings, and over time bigger swings won't mean as much to you. Like I no longer get excited on big up days, nor do I get annoyed on big down days. Okay, first I'll quickly show you each of my accounts in Fidelity, and then I'll switch into my dividend spreadsheet tool, as that's much easier to see and understand stuff about my dividend portfolios. If you've watched my previous videos, then you'll have seen my accounts in my brokerage's smartphone app, as well as showed you my portfolios when I was in E-Trade. So first up is my IRA. And I'll go over each of my tickers in my spreadsheet tool, so don't worry if this screenshot is too small for you. This shows that the total current value of tickers in this account is about $1.32 million, and Fidelity estimates that my IRA should generate $56,917 of dividends per year. When I show you my spreadsheet, it will more accurately estimate my dividend income because I dynamically adjust it in real time due to currency fluctuations that 2 of my non-US tickers have, which Fidelity doesn't do. And note, when I moved my accounts from E-Trade to Fidelity, they sold the fractional amounts of each ticker I had, rounding me to the nearest whole number, so any fractional shares you see now means that I bought, dripped, or sold some fractional amount of shares since I moved. I turned off my drips a few years ago once my dividend income was more than my family's expenses, which means that's when I started living on my dividends, and so now I'm just withdrawing almost all of them. I say almost all because I do invest a small portion of my dividends into a few tickers, like Devo, which is why it's highlighted in the middle here. Basically, each month I've been reinvesting $100 of my Devo dividends to buy more of itself, and since it paid out today when I took this screenshot, then I also bought some more of it using its payout, and so Fidelity highlights that recent buy. Okay, and next up is my taxable account. Here my total current value of tickers is about $1.44 million, and it generates $61,229 of dividends per year. Almost all of these are qualified dividends, but I do have one material position in an MLP called Enterprise Products Partners, and all its payouts for the next 7 to 10 years should be return of capital, which means they'll come to me at a 0% tax rate. My CPA just did my taxes, and sure enough, that's how things played out, and MLP's K1 was simple for him to utilize, though I'm glad that I didn't have to do it. And then last up is my wife's rollover account that I manage. Here the total current value of tickers is about $180,000, and it generates $7,615 of dividends per year. So between all three accounts, Fidelity estimates that my $2.9 million portfolio generates about $126,000 of dividends per year. And this week was when I hit my record for most dividends ever in one day, and specifically it was on April 30th where I got payouts from 3 tickers. Here's the screenshot of the activity screen on Fidelity, which shows what dividends I got and any buys or sells that I did. So listed first is the $100 of Devo I bought, and even though I placed an order for $100 of it, it ended up buying $99.98 worth. And then the first dividend I received on that day in the rollover account, and it's a dividend from TD Bank for $9.96. Then $417 of Altria dividends came in the rollover account as well, followed by $2,795 of Altria in the taxable account. Then $592 of TD Bank dividends in the IRA account. Then it shows my Devo buys, and then it lists $510 of Altria dividends I got in the IRA, and finally $536 of Devo dividends paid out also in the IRA. So in total, Fidelity shows that I received $4,861 of dividends on April 30th, which was a new daily record for me. Note, Altria and TD pay quarterly, and Devo pays monthly. And for reference, my previous max daily dividend payout was from a day in November where I got $4,565 of dividends from AbbVie, BTI, Colgate-Palmolive, Realty Income, and Procter & Gamble. And I gotta say, it's pretty darn amazing to make almost $5,000 passively in one day. Yes, I had to work hard to get to this point, but I can't overstate how it still blows me away to make true passive income like this. I mean, looking back over all the jobs I've had in my life, starting with construction jobs I did during the summers in high school, to when I was a front desk clerk at a hotel, to graduating college and becoming a programmer, and then moving on to doing IT management stuff, all those jobs took at least 40 hours a week of effort to get the moolah. I had some good jobs and I had some toxic jobs, but I never loved my jobs enough to actually want to do them, so now I really appreciate having money flow into my accounts without having to do anything. And even if I croak, my dividends will keep flowing in, paying for my wife and kids, and I really value that aspect as well. Okay, now before I go over each of my tickers in my spreadsheet tool, I'm going to take a quick detour and tell you a few things about myself, but feel free to use the timestamp on screen if you only care about the stonks. So if you watch my older videos, you'll find out a ton more details about me, from what my salary has been like over the years to what my social security payouts should be like when I'm old enough to qualify for them, as well as how I pay for my family's healthcare now that I don't have a 9-to-5 job, and why I started my YouTube channel, amongst other things. I've done around 300 videos in the last almost 5 years, but don't ask me what video has what, because I probably won't remember. Part of my reality is that I've had some nasty health issues over the years, stuff that impacted both my brain and my heart, leaving me today with periodic and recurring amnesiatic episodes that have left doctors stumped. I've worked with specialists all around the world, from neurologists and cardiologists, dietitians, researchers, etc., and they still haven't figured out what's going on with me. But fortunately I've battled my way through all the health issues, and I've never been happier than I am right now. I mean, getting to a point where my dividend income was more than our expenses was honestly life-changing, as was retiring early when I was still in my 40s. Every day I'm truly grateful that I can do pretty much whatever I want with my time, which for me is doing stuff on social media and family time and movies and working out and stuff like that. But getting to this point wasn't easy. Like one time in the 90s, I was working at a small startup as a junior level programmer, and they'd given us all some stock options, and right before the dot-com bubble burst, they talked about going public, and if they had, then I'd have become a millionaire overnight, at least for a short period of time. But they decided to wait, and then the dot-com crash happened, and I ended up leaving them shortly before they went under, and unfortunately the stock they had given all of us was worthless. Another time I got financially screwed was at a company I worked at where I was in technology management, and I got a bunch of RSUs for helping achieve some corporate goals. RSUs are restricted stock options, and you can think of them basically like free stock. And when you get RSUs, they show up like cash in your paycheck, and the company can withhold some of your payout for taxes, even though they don't know what your actual tax rate will be. But my company said that I couldn't sell my RSUs due to some litigation they were going through, so it was like they had given me some cash that I got taxed on, only I couldn't sell them. Then that company ended up almost going bankrupt, and the stock completely crashed, and I still wasn't allowed to sell. So because of how they did their accounting, I ended up effectively owing more in taxes than I actually got when they finally allowed me to sell. TLDR, I got screwed, and I should have gotten a lawyer to fight them, but at the time I was going through some crazy health issues which screwed up my mind, and I ended up leaving that company and I signed their severance agreement, which I also shouldn't have done without talking to a lawyer, because I gave away my rights to be able to sue them for what they did. Leave me a comment telling me a time where you either made a bad financial mistake or you had something bad happen to you. Anyway, I've also had some fortunate financial things happen to me over the years, with the most impactful one being when a coworker at my first real job convinced me to start investing. And it's because of him that I managed to build my retirement account to over $1 million with just small recurring contributions and company matches over the 30 years of my career. My taxable account also came mostly from lots of small contributions, with some bigger lump sum investments from when I'd get a bonus at work or if I sold a house for a profit or something like that. So my message to everyone out there is that small investments over multiple decades can really add up, and don't quit investing if you have some bad luck. The longer you invest, the more something bad can happen, and you just gotta accept it and keep investing. I've invested through some of the worst stock market crashes in history, including the dot-com crash, the '08 financial crisis, and the pandemic. And I also had to live through the last decade where it took many stocks over 10 years to get back to their previous highs, and all of those crappy times helped me become a long-term investor. Plus, bad markets helped shape why I became focused on blue-chip dividend stocks over anything else. I mean, right now my portfolio could drop 50%, and it would be pretty much meaningless to me as long as my companies kept paying dividends, because I have no intention to sell and lock in those losses. I've seen countless people quit the market when their portfolios got hammered because it felt like they lost everything, but when I was focusing on dividend income from solid companies, then I never felt the same sense of despair. And dividends aren't guaranteed, but I found that if you have a diverse basket of quality tickers, then you have a very good chance of them paying out, and over the decades that I've been investing, I've only had a few tickers that ended up suspending or cutting their dividend, and when they did that, I'd move into something else. Okay, let's jump into my spreadsheet tool, and note my spreadsheet is only available for my Patreon Aristocrat and King members, and I'm still all sold out so no one else can join for now. My spreadsheet interfaces with multiple databases, and it calls APIs over the internet because I pay for better stock data, so I can't sell the spreadsheet as a standalone product. And here's a zoomed out view of my portfolio that I took after the market closed on April 30th, which was a red day, and I've sorted my tickers based on market value, so largest positions on top. Feel free to watch my previous videos if you want to know what all the highlighting is about, but basically different colors provide different insights into the underlying data, which lets me quickly glance at my spreadsheet and understand a bunch of useful information. We can see that overall my portfolio ended down 0.91% for that day, which means it dropped about 27 grand. But compare that to the SP 500, which was down 1.57% for the day. My conservative portfolio tends to lose less on down days, but that also means it tends to go up less on up days, and since historically we've seen more up than down, then that often means that my portfolio would underperform the market. But as someone who's in retirement, that's what I prefer to have, i.e. a bit less volatility and a bit more capital preservation. If we go into an extended recession, then I'll probably overperform. And if I was younger and focused on growing my portfolio, then I'd hold some different stocks at different weightings. Mine is built to enable my needs, goals, and risk tolerances, which is why I say you shouldn't copy my portfolio. My portfolio used to have more growth in it, and if I was young and focused on growth, then I'd not own tobacco stocks or covered call ETFs or utilities or stuff like that. Okay, and on the bottom of my spreadsheet, we see that my portfolio's total value is $2.931 million, and it generates about $126,000 a year in dividends, similar to what Fidelity said. My annual dividend income slowly tends to trend up as I move forward in time, due to dividend hikes I get along with any other additional shares I purchase. Of course, if a company of mine cut or suspended their dividend, then my go-forward income would drop. My portfolio's average weighted dividend yield is 4.3%, which is just what today's starting yield is, weighted by how much of each ticker I have in my portfolio. Newer investors sometimes mistake current yield for portfolio returns, which is different. And for reference, before I retired, my portfolio's average weighted yield was decently lower because I was more optimized for growth over income. But then as I wanted more income, I moved out of some of my lowest yielding stuff and into higher yielding things that I felt were still reasonably safe. And again, a question I sometimes get is why I just don't put everything in a savings account or a CD or a treasury bond, which wouldn't have all the risk of stocks and could make 4 or 5% or whatever. And you can watch my video called 2 million plus dividend portfolio, new daily, weekly, monthly, and yearly dividend records, where I give a nuanced response to that question. Another question I'm often asked is if I do options on my tickers, and the answer is I used to but no longer do, and you can watch a video I did called What I Learned Living on Dividends for 3 years to understand why. Okay, my portfolio's average weighted dividend CAGR is 5.84%, which just means that my stocks have historically raised their dividends by 5.8% per year, on average, at least for the last few years. For me, I'm cool if my dividend income tends to outgrow inflation, on average. Moving on, my portfolio's average weighted PE is about 19.8, and I tend to feel that a 15 PE is a more reasonably priced ticker, generally speaking, so my 19.8 tells me that many of my stocks are probably overpriced. My portfolio's average weighted beta is 0.55, which generally means it's less volatile than the overall market, and like I said, that also tends to mean that I lose less in down markets, but also gain less in up markets. Looking at my total share count, we see that I've got 37,640 shares. Okay, now I'll zoom in a bit. Here we see that SCHD is my largest position, and I have about 205 grand of it, which generates $7,118 of dividends per year. Dividend ETFs like SCHD, and dividend stocks as a whole, tend to do worse when interest rates are high, which makes sense because investors often look for yield somewhere, and if they can get it safely somewhere else, then they'll sometimes do that. Then once rates fall, then tickers with dividend yield get more compelling to many investors, and then as the buys flow in, it pushes prices up. Ironically, most people invest when prices are high because everyone is buying so it must be good, and then they sell when prices are low because they're worried that things will keep falling, and both of those actions are often the exact opposite of what the best financial move would be. These days I'm dripping a bit of SCHD's dividend into itself in my retirement account. And after SCHD, my largest position is Realty Income at around 192 grand, and which generates $11,050 a year, or $920 a month. I have a goal to build my O position until it's yielding at least $1,000 a month, so I'm slowly dripping some of its dividends into itself, especially now that I think it's cheap. Like, take a look at this FASTgraphs of it. The black line is its stock price over time, and it's currently under the blue line, which is its normal price to AFFO ratio. I think of it like its average PE over time, only you don't use PE for REITs. The black price line is also under the orange Graham-Dodd ratio average for lower growth companies. So TLDR, O is looking cheap right now, which is what you'd guess it would be given all what's going on with interest rates. And remember, FASTgraphs isn't calling out business risks, it's just providing some data on how its current price looks in comparison to some historical trends, as well as gives insights into how future growth may look, amongst other things. And just because I'm willing to risk buying O at this time doesn't mean you should. After O is Altria, worth 166 grand, and which yields $14,892 in dividends a year. Then AbbVie, worth 151 grand, and which yields $5,778 a year. Then Microsoft at 145 grand, and which yields $1,122 a year. Then ExxonMobil at 142 grand, which yields $4,579 a year. Then we have J&J at about 140 grand, and which yields $4,796 per year. Then JEPQ, worth 137 grand, and which yields $12,711 per year. I've been pleasantly surprised at how JEPQ has been doing, but I guess it kind of makes sense given its tech focus, and volatility has been nice to it. It's another one of the tickers that I've been slowly dripping some of itself into. Then the final ticker on this first page of 3 is Pepsi, worth 135 grand, and which yields $4,162 per year. Moving on, we see my MLP and Enterprise Products Partners, which yields $9,854 a year. Then Devo, another ETF I'm liking, and it yields $6,096 a year. Then Procter & Gamble, which yields $3,100 a year. Then McDonald's, which yields $2,738 a year. Then Duke Energy, which yields $4,415 a year. Then Coca-Cola, which yields $3,232 a year. Then BTI, which yields $8,289 a year. Southern Company, which yields $3,222 a year. And the last one on this page is Chevron, which yields $3,279 a year. And now onto my last page of tickers, and we see Kimberly-Clark, which yields $2,723 a year. Then Goldman Sachs, which yields $1,953 a year. Then Apple, which yields $391 a year. Caterpillar, which yields $1,076 a year. Then Philip Morris, which yields $3,452 a year. Colgate-Palmolive, which yields $1,334 a year. Then Toronto Dominion Bank, which yields $2,406 a year. Then Home Depot at $900 a year. Then Travelers Companies at $651 a year. And finally Starbucks at $709 a year. And man, they got nailed hard due to their weak earnings report this quarter. Moving on, here are two graphs that my spreadsheet creates, where the top one is portfolio value by sector, and the bottom one is passive income by sector. So like healthcare is 9.9% of my portfolio by value, but only 8.4% of my income. Sin stocks are 10.7% of my portfolio by value, but are at a much larger 21.1% of my annual income. My top 3 sectors by value are consumer staples at 17.1%, energy at 12.2%, and tech at 12%. And note, ETFs aren't a classic GICS sector, nor are Sin stocks, though I've taken the liberty to categorize these sectors as I like to see them. My largest sectors by income are Sin, and then energy at 14.1%, then tech and consumer staples at 11%-ish. My smallest sectors are industrials and financials, so over time I'll probably slowly rectify that, though I'm not doing that right now. And then here's a screenshot of what I call my dividend calendar view, which shows me what dividends I've been paid in the past and what dividends are scheduled to be paid in the future. The current month in May is highlighted in green because I took this particular screenshot on May 1st, and to the left of it are dividends I received in previous months, and to the right of it are dividends I expect to receive in future months. So like SCHDs in the first row, and I got $1,969 of dividends in December of 2023, then $1,624 in March of 23, and then I'm estimating that I'll get $1,779 in June and in September. Though those months are a little bit screwed up, and I'll tell you why in a moment. One thing I don't like about ETFs is that each payout varies, unlike single stocks which tend to only go up or down if you bought or sold stocks, or if their board of directors voted to change their dividend. So the interesting weirdness for SCHD in 2024 is that their payouts don't follow their normal quarterly cadence. What I mean is that normally SCHD pays out in the third month of the year, which is March, the 6th month, which is June, the 9th month, which is September, and the 12th month in December. So 3, 6, 9, 12. But Seeking Alpha showed me that in 2019 they paid out 3, 7, 9, 12, i.e. they paid out in July rather than June, and I think they're doing that again in 2024. When I saw that info, I thought that maybe Seeking Alpha had some bad data, because no site is perfect, so I went to Schwab's site to double check what it had, and it said the same thing. Now, officially SCHD's X date remains in months 3, 6, 9, and 12, so they are still paying quarterly, so to speak, but it's just that you can actually receive the dividend in an off month. And it looks like SCHD normally pays out near the end of the month, but they have paid on the first of the month, probably due to weekend timing or something like that, and that's what seemingly throws off the payout date cadence. So TLDR, they still pay about every 90-ish days, but if you just look at the specific month you get paid out in, then there can be times where it isn't every 3 calendar months. Okay, and below SCHD you can see Realty Income's payout over time, and notice how it's slowly increasing due to my smaller reinvestments into itself, along with any dividend hikes that O did. So I got $911 of dividends in November of 2023, then $912, then $915, $916, $917, $919, and I'll get $920 this month in May. All the future monthly Realty Income payouts are estimated at $920 because my spreadsheet doesn't model any potential hikes, and it only displays what it's at. I find this calendar view of actual dividend payouts and future probable payouts is very interesting, and you can see how dividend ETFs vary on their payouts, and you can see how non-US stocks vary on their payouts due to changing currencies, and you can see how good stocks' dividends go sideways and up. On the bottom of each column is the sum of total dividends in that month. So in November of 23, I got $9,855 of dividends. Then in December, I got $12,021. Then in January, I got $9,298. Then in February, I got $9,891. Then in March, I got $10,919. And in April, I got $10,229. And this month, I'm scheduled to get $10,024. Then future months are estimated to be $10,443, $11,895, $10,122, $11,182, and $10,205. Most likely my future months will be a bit higher than those estimates due to reinvesting small amounts into SCHD, O, JEPQ, and Devo, and due to dividend hikes I expect to get. Like I'm guessing I'll get an Apple hike soon, then a Caterpillar, then maybe Goldman Sachs, Duke, EPD, Altria, etc. As long as your companies are growing, then they can continue to raise their dividend. If they struggle too much, then they'll have to cut their dividend. I just saw last night that Leggett & Platt decimated their dividend, and that's after decades of increases. I sold out of Leg a while ago because I wasn't enthused with them, so I called that one right, but if you're still holding Leg and you're annoyed, then that's understandable, and that's also just the unfortunate reality of investing. Sometimes things won't turn out as you like, and you just gotta take your punches and keep moving forward. Trust me, I've called lots of things wrong over the decades, and it sucks, and you just deal with it and move on. If you don't quit, then your results can look like this income chart that I've used as part of my thumbnail that shows my historical dividend payouts month over month, going back until the time I created my new spreadsheet product over 4 years ago. Now, I anticipate that my dividend income will grow at a slower pace going forward, as earnings in the economy are puttering along, but I still think it will still trend up over time, with a few hiccups now and then that I'll have to deal with. And again, if my company doesn't cut, or if I suspect it'll have to, then I'll probably drop it and move into something else. Okay, now let's look further into the future at what my dividend income could be. This chart assumes that my historical dividend CAGR holds going forward. The blue columns are the no drip estimates, and the red columns are the faster compounding drip estimates. We saw that right now I'm a bit over 125 grand a year in divvies, and since my drips are off, then I'd expect to grow more like the blue columns, so like 8 years from now I'd hit around 200 grand in annual dividends. But if I was dripping my dividends rather than using them for expenses, then the faster compounding represented in the red bars would probably be more indicative of how my income would grow, and so by year 9 I'd hit 300k a year in dividend income. And since I'm reinvesting a small percentage of my dividends, then maybe I'll grow somewhere faster than the blue bars but slower than the red, assuming my dividend CAGR holds. And here are some of the numbers behind that chart I just showed you. So the top line is the no drip one, and I started at 126 grand a year. Then a year from now it estimates I'd be at 133k, then 141k, then 149k, then 158k, etc. The drip line is the bottom one, and it shows how reinvesting all your dividends means you grow your income faster. So like I started at 126 again, but then it goes to 139k, then 153k, then 168k, etc. I didn't model inflation in these lines, but I have an input field you can use if you want to reflect your buying power over time by applying whatever amount of inflation percentage you want to model. And for fun, if we look up to 30 years out, you can see some really insane dividend income estimates, which obviously become less accurate the further you look out in time. So like 30 years from now, it estimates that I'd be making $691 grand a year in dividend income if I was spending all of it each year and if my companies kept increasing their dividends as they have been historically. Or I'd be making a whopping $1.78 million a year if I'd been reinvesting my dividends that whole time. And here are those 30 years of estimated future incomes graphed out, with no drip in blue versus drip in red, and this really visually shows you how powerful that a dividend snowball compounding can grow things. Okay, and another view I have of my dividend income is this chart, which breaks it down into other time frames for fun. So I'll make about $10,500 a month on average, which is about $2,400 a week, or $345 a day, or $14.40 an hour, every hour, year-round, even while I'm sleeping or playing video games or whatever. I also list what I call my hourly wage number, which is how much my annual dividend income would be in buying power equivalent to an hourly worker, assuming my dividends were all qualified dividends in a taxable account and I had no other income. Of course, in my particular case, I do have some early distributions from my IRA, so that makes my hourly wage equivalent amount to be less than that, but I also have a nice MLP, which makes it better on average. But the real key point is that a dividend dollar is usually more powerful than a wage dollar, because taxation is often better when comparing qualified dividends versus wage income. Plus, because your dividends come in 24/7, whereas most hourly workers are taking time off for PTO or sick time or whatever. And I just saw an article today that said on average, Americans valued their time at $240 an hour, or about $500 grand a year, which is about 8 times higher than the average salary of $59K a year. And because people value their time so highly, many are willing to spend money to get a little more or to achieve a happier life. Like, that's part of why people will spend $7 on a cup of coffee, just because it brings them a bit of happiness. And I get that. We all sometimes feel like we want to splurge a bit, and I think that can be healthy. But that's also why I value dividends so much. I mean, they're the only true source of passive income out there outside of bank interest. And the fact that it's passive gives me what I value the most at this stage of my life, which is time. Time to chat with my family and friends, time to do fun hobbies like social media, time to veg out, whatever. I don't need to spend time selling stocks, worrying about if my ticker is underpriced, but I still need the cash or anything like that. I don't need to spend time worrying about how my family will make money if I'm not here. Dividends give me so much more than what people might realize when they look at them at a surface level, without truly understanding the sum total of what they represent to me. So the bottom line takeaway from this video is to invest. Yes, you want to make sure your bad debt is paid off, and yes, you should build up a few months or more of an emergency fund, but then I'd focus on investing, and of course also don't be wasteful with your spending and keep your expenses as low as possible. I have pretty low expenses, with the only big expense being our mortgage. That being said, we have a 30-year fixed mortgage at 2.62%, which is pretty sweet. I saw another article that just came out that said the typical monthly mortgage payment of a median priced house in the US was $2,700, and I pay less than that. So my point is to live frugally, and then invest your money and use it for experiences, like traveling. So invest, and invest intelligently, and you'll win over the long run. And make sure to avoid taking shortcuts to get rich. Like, I was just reading an exchange on my Dividend Discord where an international user said that his friend took a bank loan of 50 grand at a 1.99% interest rate over a 25-year period in order to buy stocks. He put all that money to buy dividend stocks at an average 3 to 4% yield, along with Altria, Realty Income, and BTI. He has to pay back $200 a month on the loan, and the dividends he gets are currently around the same amount. He figures as time goes on, his dividends will increase and he'll be able to make more money to pay on the loan, and he'll invest even more. Now, I hope it works out for his friend, but I'd advise people never to borrow to invest into stocks. I've just seen too many people lose out who took on debt to invest in stocks, even dividend stocks, and the people do it because they don't have the patience to do it slow and steady. The idea might sound good, but what happens if one of your stocks goes belly up for some unforeseen reason? I mean, people never thought Enron or Lehman Brothers would blow up, but they did. And I worked with people who lost most of their life savings due to having too many of their eggs in one basket that blew up. The pain of loss that I've seen far outweighs the joy gained from trying to get rich quick and it working out, at least in my experience. In that particular case, the person is living in Estonia and put his house up as collateral to secure that low rate. And $50K is equivalent to 3 years of his salary, so those aren't small numbers for him, which is all the more reason why I'd never do that. Now, he might come out okay in the long run, as some people do, but I'd strongly discourage anyone I know from taking on that big of a risk. Plus, sin stocks like Altria and BTI aren't things I'd want to bet the farm on. But if you don't want to listen to me, then at least listen to the most prolific investor in history, Warren Buffett, who said that the upside of borrowing to invest isn't worth the risk. Now, we're both talking about stocks, not about real estate, where taking on a loan can make sense. And I'm not saying don't take any risks. I mean, the younger you are, the riskier you can get with your investments, because with bigger risk often comes the potential for bigger reward, but also for bigger losses. I'm personally happy to invest in good, boring companies, and I think that investing a small percentage of your money into riskier things, whether they're IPOs or crypto or whatever, is reasonable. But I'd put the lion's share of your investable assets into relatively safe things, like companies that have been around for a long time, along with good rentable real estate and stuff like that. I prefer stocks because I found real estate rentals to be more time-consuming and more stressful, not to mention riskier, even when I had a property manager, but you can also do great with real estate. And if you're sitting there thinking it's impossible to build a decent portfolio, then I want you to focus on what you can do, not what you can't. I know that most people can build a good portfolio if they work at it for a long time. Like I just saw this article about a 62-year-old retiree who built up portfolios worth about $500,000 on a middle-class income of around $72,000 a year. His income came from a combination of his full-time job as a sales representative and some side hustles, like selling secondhand items on eBay. He built up an emergency fund over the years which currently sits at $9,500, most of which is in a high-yield savings account. He has a 401k that has grown up to $250K, and he tried to always at least contribute enough to get his company match. He also has a Roth IRA with about $100K in it, and has a taxable account with $110K, and he is mostly invested in Vanguard ETFs. Beyond that, he has $10K here and there in some other accounts, taking him up to about $500K overall. He said that building a $500,000 nest egg wasn't easy, but it was definitely worth it. Beyond taking advantage of employer matching contributions, he also tried to automate his savings as much as possible by setting up automatic transfers from his checking account to his emergency fund and investment accounts. That way he wasn't tempted to overspend every time he got a paycheck, since most of it had already been allocated towards his retirement. He also tried to live below his means, which wasn't that difficult for him since he was naturally a frugal person, and he's someone who doesn't crave buying a bunch of stuff. He believes his frugality is one of the main reasons why he was able to save aggressively for retirement on a middle-class income. But he did say that looking back, he wishes he had done a few things differently to better prepare for retirement. Number one, he wished he had started to save and invest earlier. He said he didn't really start saving aggressively until he was in his mid-30s, and he wished he had taken advantage of compounding sooner so that his nest egg would have been bigger. Number two, he wished he had been more proactive about seeking professional investing advice in his 20s and 30s. Number three, he wished he had built more passive income streams. He said he regrets not putting more time and energy into building passive income streams that could help him make money on autopilot while he's in retirement. Regardless, he's still grateful for the saving and investing he's been able to do, and he feels confident that he'll be able to enjoy a comfortable retirement lifestyle with a $500,000 net worth. So again, the takeaway message is to live frugally and to invest non-stupidly for the rest of your life. Maybe you'll not hit your goal portfolio amount, but I bet if you stick with it, you'll be surprised where you can take things. According to Fidelity's guidelines, you should aim to save 10 times your income by age 67. So assuming you make $100,000 a year pre-retirement, then let's say try to build up $1 million worth of portfolios by the time you hang up your cleats. Another popular way to determine how big your nest egg should be is the rule of 25. First, decide how much you'll need each year for your preferred retirement lifestyle, then multiply that number by 25. So if you want to live on $50,000 a year in retirement, then you'll need at least $1.25 million saved to achieve that goal. If you're wanting to go down the dividend route, then you can divide your annual expenses by your average weighted portfolio yield to figure out how large of a portfolio you'd need. So like if you wanted $50K of dividends each year and you wanted a portfolio at a 4% yield, then you'd need a $1.25 million portfolio to sustain you. And start small. Maybe your first big goal is $10K of dividends a year, which might be a $250K portfolio. Your strategy might be some dividend income along with some social security and maybe some part-time temp job or maybe some pension or whatever. Don't get discouraged if you're at zero, and don't get discouraged where I or anyone else is, because that doesn't matter. What does matter is if you decide to go on a better path and you actually start investing. Fidelity found that many Americans now opt for a non-traditional approach to retirement, whether that's continuing to work part-time in their golden years or even starting their own business in retirement. Across generations, about 2/3 of people look forward to pursuing work for pleasure while in retirement and hope for a phased retirement, which is working full-time at first, then part-time, then stopping altogether. And with that, I'd like to close things out, and I'd recommend you consider using my FASTgraphs affiliate link along with my coupon code in the description of this video, as using both will allow new users to get 25% off their first payment, even if they sign up for a full year. Plus, check out my Seeking Alpha affiliate link, as new users often get distinct benefits for signing up. Finally, take a look at joining as a channel member, or check out my Patreon to see if it has any seats you want to join up for. Whatever you do, please hit that thumbs up button, subscribe if you haven't yet, and click that bell notification. And don't forget to join my free Dividend Discord chat server, which has over 11,000 dividend investors on it from 81 countries around the world. Thanks for watching, stay positive, and I'll talk to you again real soon. Remember, I'm not a financial advisor, and my videos are for entertainment and inspirational purposes only. Investing of any kind involves risk. I'm only sharing my opinions with no guarantee of gains or losses on investments.